All right. What's up, folks? Happy Friday, July 11th, 2025. My name is Hamilton here with the Trading Initiative. Didn't realize that this was scheduled for public as well. So a couple of public sessions here this week. But you'll have a better understanding of the way that we view the market and how we put together game plans and move through these choppy parts of the market. As we're seeing over the last week, the indexes have chopped around here, both the Qs and the S&P 500. While we have hit all-time highs intra-week, we are chopping around, and we are heading into Q3 earnings season. And we're going to focus on that over the next 15, 20 minutes. It's kind of the game plan here for the earnings season coming up. Starting next week, we have the banks. So we're going to focus on exclusively today. But we're also just going to talk about general market moves. As I said over the last week, we've chopped around last 5 trading sessions, not making any significant progress to the upside. I do believe that there's a chance here for a pullback, and I don't know exactly how deep this pullback is going to go, but what I want to point out first off, every time I say that there's going to be a pullback, natural inclination for traders is to say, do we sell everything or do we hedge, or what do we do to protect ourselves from a pullback? I cannot stress this enough. You don't have to do anything. You do not have to do anything. You can simply expect a pullback and take advantage of it by buying on the bounce. You do not need to time the top. You do not need to hedge. The problem with timing the top and selling a significant portion of your holdings that are working or hedging is, first off, if you sell a bunch of stuff and you miss the bounce, then you're in a worse position on the way back up than you were had you have just held through the drawdown. Particularly if you're trading options. It's very, very difficult if you miss the pivot to get in without overpaying for a contract. Secondly, if you're hedging, by all means, you can hedge. I have no problem with that. I will tell you, though, after running TTI for 5 years and going through trades with traders, seeing their trading journals on TraderView, etc., most people lose more money hedging than they do protecting their portfolios. It's just the way the market goes. Hedging is not easy to do. Particularly if your portfolio is not built around a very specific idea, it can be very challenging to hedge. It's not as easy as just buying puts in the S&P 500. It seems easy in theory, but when you actually go and apply that, it doesn't always work. And so a lot of people actually end up losing more money hedging than if they would have just fucking bought the dip or just sat there through the pullback. So I think the data suggests here that July tends to be a strong month. It's one of the strongest months of the year, but we are coming into a seasonally weak period of the market, which is the summertime. If you've been trading the last couple of years, summer has been particularly volatile. Last year, we had the Japanese yen carry blow up. The year before that, we had the summer lull that started in late July, and we bottomed in the end of October. So we had back-to-back pretty difficult summers. But it also opened up the market for some incredible buying opportunities. For those of you that were in TTI back in 2023, we bought a couple of days after the market bottomed, and we pushed the gas pedal down above the 200-day moving average. I mean, this is like trading 101. And our best trades came in Q4 of 2023. Same idea as 2024. The market came down in August, and we started buying a week after we had bottomed, and the best trades came in Q3 and Q4 of 2024. Now, I don't know if we're going to have some sort of crazy pullback and then some prolonged kind of corrective phase in 2025. I would actually assume we don't. And before everyone goes, well, wait a minute, it just happened 2 years in a row, let me express my idea here. The idea is that, generally speaking, you have one correction per year, meaning that the market pulls back 10% or so once per year. That's pretty normal. We got that times 2 and a 20% pullback in the first quarter of 2025. So it would be out of the realm of statistical probability, if you will, to have 2 corrective phases this year. I'm not saying it can't happen. I'm just saying if you look at the stats, it's not usual. So I think a lot of the summer weakness that we typically see was front ran from February through April, where we saw this was a massive, massive move down. Mag 7 stocks got absolutely slaughtered. High beta growth stocks like semiconductors got slaughtered. These are the types of moves you see in like bear markets, not corrective phases. And so now you have to ask yourself, well, if we shook out a lot of that overabundance, a lot of that bullishness, a lot of that complacency in the first quarter of 2025, you have to ask yourself, are we still going to get that same normal corrective behavior during the summer, or at the very minimum lower volatility? I don't think so. I think that we front ran a lot of that in Q1 of 2025. Part of the reason why I'm saying that, if you're inside of TTI, you know this because we talked about it a lot, is we tend to see waning market breadth coming into the summer months, right? Wall Street goes on vacation, there's a lot less volume, things get choppy, and then we get some sort of pullback. We're not seeing any of that, at least yet. If we look at, for example, equally weighted NASDAQ, we were at all-time highs this week. If we look at equally weighted S&P 500, we're very close to all-time highs. We're not getting any of that normal weakness heading into summer whatsoever, which is very surprising. But at the same time, it gives us an ability to potentially build this expectation for what do we expect in the summer. We also have crypto that's running. And I know not everybody here is trading crypto. If you're in TTI, this is our big win today, ETHA. Huge win for us. I'm up over 100% in like nearly every tranche. Made a lot of money on this trade so far, and I think we're going to make a lot more. But you have to assume, once again, if crypto is running, think about this from a liquidity standpoint, from a risk scale standpoint as well. The crypto market has got to be one of the furthest asset classes out to own in terms of risk, and we're seeing liquidity flood the market. If liquidity is flooding the riskier parts of the market, is it really prudent to sit here and assume that this market is going to pull back and hit another corrective phase? I don't think so. I really do think that this summer is going to catch a lot of traders off guard. You know, the sell in May and go away crew completely demolished. It's July 11th. The indexes are at all-time highs. If you sold in May and went away, you're fucked. Like you're looking out on the way in at all-time high prices across the board on a lot of the most important stocks. You're screwed. And I think the summer might be alluding to summer. I think that summer might be one of these summers like back in 2021. For those of you that were trading in 2021 or in 2020, kind of the COVID bubble, we saw the summer months pretty much run. Right? Small cap summer. For those of you that were trading small caps, like I remember Kodak. KODK. You guys remember this? There was a rumor going around about a COVID vaccine, and this thing went from, there it is, 2020. I mean, this is the type of stuff that happened in the summer of 2020. I think that we could be facing something similar, not necessarily Kodak back up 5,000%, but I think that it's going to be more bullish than most people expect. I think that the pain trade is still up. I think there's not a lot of people that are willing to buy higher prices, which means prices will probably continue to go higher. And force them in at higher prices. Market sentiment, we talked about this earlier this week inside of TTI. The AAII investor survey is more bullish now than they have been for the last 6 months. And the NAAIM professional money manager survey is more bullishly allocated than they have been all year as well. So we don't have that contrarian market sentiment behind us anymore, but we do have an overwhelmingly large amount of liquidity entering the markets. We're seeing that through sector rotation and new valuations and in the largest companies in the world. I mean, NVIDIA just hit $4 trillion for the first time. And not only are we at $4 trillion, we're well above $4 trillion now with NVIDIA's big move, up 2% today. By the way, if you're inside of TTI, how much exposure do we have in NVIDIA right now? It's completely free. We're going out into the end of 2025, beginning of 2026. We absolutely fucking nailed this trade. Also Microsoft, right? Microsoft all-time highs. We have a bunch of Microsoft as well. None of this shit is luck, folks. If you're inside of TTI, you've seen it play out the last couple of months now. Right? And the process remains the same. If you're in a bull market, you buy the leading areas in the market and you hold on and you try to ignore everybody else. Okay, so that's general thoughts. I think market's going to pull back in the short term. I think summer's going to be very good. I think this pullback in the summer pullback within the next week or two potentially, I think is going to offer opportunities for us to buy more stocks. Buy more stocks. We're in bull mode, right? Risk on across the board. All of our risk ratios are screaming at us to continue to buy stocks. Leading areas of the market like tech, communications, leading higher industrials, and then what I want to talk about right now, financials. So let's talk about financials. Let's pull up the Earnings Whisper release here. We can see next week really kicks off earnings, but it's the big banks that I'm focused on here. I'm looking at JP Morgan, Wells Fargo, Citigroup, BlackRock. A lot of this stuff is front run, right? Tuesday morning. Then Wednesday morning, we have Bank of America, Goldman Sachs, Morgan Stanley. Like this stuff matters. And if you're inside of TTI, we have exposure into a bunch of these banks, right? We have JP Morgan. We have Wells Fargo. I'm trying to think off the top of my head all the trades that we have on right now for banks. We have Bank of America. Some of you might still have an old school Goldman Sachs and Morgan Stanley position that should be working well, right? So we have exposure in this area. And typically what we see when banks start to report, they set the vibe, if you will, for the rest of the earnings season. I will tell you that typically, at least going back a year or two, JP Morgan has been sold off into the earnings, and that's kind of what we're seeing right now. We had talked about this inside of TTI earlier this week, and I think this is valid. I want to buy weakness in JP Morgan prior to earnings, but price the play to go to zero. So some shorter term earnings related plays here. Allocate only enough to where if it goes to zero, you're comfortable with that. But if it hits, I think it's a great opportunity to be able to add into longer dated positions in JP Morgan, which is exactly what I want to do. I don't think you have a bull market without financials contributing. And I think that if the bellwether stock of JP Morgan does not do well and starts to break back down and lead financials down, I think that would be detrimental to the entire sector. So I'm looking to buy somewhere near the 280 area. I took a couple small nibbles a couple of days ago when we dipped down here. We talked about it in the chat room. There will be an official play that goes out later today on JP Morgan. If you're willing to take that, feel free. But this is arguably the most important stock in the financial sector. Sets the tone for the rest of the banks, etc. It reports Tuesday morning. This is what I'm focused on, the response to JP Morgan. You go back through the previous earnings reports, JP Morgan tends to get killed prior to earnings and occasionally gets killed during earnings, but it beats earnings every single time, and the trend is still higher with an upward sloping 200-day moving average. So until that changes, we are not going to change the way we trade this. Buy the dips at logical levels, reduce risk at 100%, and continue to hold this bull market as best you can, right? So JP Morgan is, to me, the number one most important. We have Wells Fargo that was recently just up at all-time highs. We have a position in there. A lot of you guys are able to flip it for free. But just like JP Morgan and the rest of the financial sector, hasn't really done a whole lot over the last week. We have Bank of America, like I said, and let's see here, Goldman Sachs, Morgan Stanley. Outside of this, we have a couple of stocks that we actually just have recently entered, right? We have a short-term Alcoa trade. We have a TSMC, like TSM. We're very bullish semiconductors, TSM here, consolidating prior to earnings. I like it. It's at all-time highs, little bull flag here, symmetrical triangle. I think the big takeaway here coming into Q3 earnings is if you get out of the mindset of trying to predict how earnings are going to come out. Meaning, are they going to beat? Are they going to raise guidance? Whatever. If you're a technical trader, your sole responsibility through earnings season is to protect your ass, right? Always protect yourself first. But secondly, how does the market respond to earnings? It has nothing to do with how you think the market will respond, or if it's manipulated, or if it's wrong. It doesn't matter what you think. Respectfully, what matters is what the market thinks, and the market will tell us immediately by responding to the results. So, for example, there's a lot of people out there that are saying semiconductors have run too far, too fast. Coming up to earnings season, there's an opportunity for these things to pull back. I would take the other side of the trade there, folks. Semiconductors are breaking out finally after a year into all-time highs. It's been a year since we've been back here. July of 2024, it's July of 2025. July of 2024, we peaked, and February, we bottomed. 40% pullback in semiconductors. These are bear market moves. I keep saying that. I'm going to continue to say that. These are bear market moves. If you expect this earnings season to kill the momentum in semiconductors, you are arguably not a trend trader. I mean, everything here is screaming at you that the trend's going to continue higher. Now, I don't know if the very next day the market's going to buy this stuff or not. I have no idea. What I do know, though, is long-term trends in semis and tech are now flipped up after a year-long consolidation fractal plus a 40% drawdown. And if you're looking to take the other side of the trade, you're probably not going to be right. If you are right, you're going to make a lot of money because it's not consensus here. It just doesn't make any sense to be short this stuff. If it does end up being right, you're going to make a bunch of money, but the probability is very low for you folks. Very, very low. We also have exposure in 3M. So next week is going to be a big week for us inside of TTI. We have exposure in the bank stocks, which are doing well. Right? We have the JP Morgans, the BKs, and everything else. We have a bunch of semiconductor exposure. We just went through NVIDIA. We have TSM. We have a bunch of other semis as well that are doing well. We have Netflix, old school position in Netflix. I had asked a question on Twitter a long time ago, which trade would have been better, Netflix or Spotify? We're starting to see a little bit of a pullback here in Netflix, but what an incredible move off the $700 range and then off the April 7th low. I mean, these are the types of stuff that you want to be positioned for. both of these things pulling back slightly because sectors matter, right? Remember, the individual stock itself can be very, very strong, but if the sector that it's in starts to fail, you have to be careful. We're starting to see some pullbacks in some communication-related names, Spotify, Netflix, etc. So be careful in terms of how you want to allocate yourself towards earnings. There's a reason why we haven't bought any new positions in these, right? We have old positions working well. They're already free, up hundreds of percent. In some cases, they were worth thousands of percent. We're not looking to reallocate into this stuff prior to earnings because there's no real area to bounce off of. Spotify pulled back. I don't play short-term moving averages when it comes to adding in exposure. I don't think there's edge there for me, at least on the time frame that I'm looking at. So I'm looking for a pullback to 650 in Spotify, and then Netflix, I'm looking for a pullback all the way to like 1,050 or 1,100, something like that. I don't know if it gets there, but if it is, opportunity to add in. Think of JP Morgan. We have an opportunity here. That's what I'm looking for. I'm looking for logical levels to add risk, and if it doesn't work out, I can cut it. So that's what I'm going for next week. The JP Morgan trade is going to be out later today. And then kind of the theme here over this week at least has been shit stocks, meme stocks, shit stocks. Earnings reports, I'll tell you right now, the biggest stuff in the market as it comes out with earnings next week, probably not going to impact small caps on a company by company basis. Reason why is a lot of these small caps that we've been trading, things like Rocket Lab, which is up into new all-time highs today, or things like I don't even know what else, CAR, which is up into, might be closing at 52-week highs today. Things like this. I mean, smaller market cap stuff that is listed in the Russell 2000 or whatever. JP Morgan might come out with some bad earnings and the market falls, but small caps, if we're in small cap season, which it certainly feels like the junkier the better, they're arguably not going to get hit as much as some of the bigger stuff in these indexes. So think about stocks that are within the Qs. If we have a bunch of the Mag 7 come out with bad earnings and the market hates it, those are going to get hit a lot harder than some of the shit stocks that we're trading right now. It's all about where we're at within the market cycle. And you can tell that the market cycle right now is loving these shit stocks, these meme stocks. CAR, Rocket Lab, there's probably a million that I can't remember off the top of my head because there's so many that are working. SMCI, Supermicro, RGTI was a big one for us, right? These are huge. AEVA was a big one for us. RIP, no more position in this, but still, right? From $8 all the way up to nearly $40. This is the type of stuff that's working right now. So that's why we're going to continue to look at this type of stuff. So next week, the game plan, we're going to own some shorter term JP Morgan stuff. If it works well, we're going to flip it and we're going to buy some longer dated stuff into the end of the year. If it doesn't work well, we're going to take the loss on the chin. It should be a relatively small loss, and that's okay. And we're also going to look at some of the trades that we have on right now, make sure they're free prior to earnings. If they're not free, we will manage those prior to earnings. If they are, it's completely up to you whether or not you want to hold those things through the earnings report. Once again, I do think there's a pullback coming in the market. I am going to be fully focused on buying it. As always, inside of TTI, I'll keep you guys updated on what areas of the market I believe are going to be the best areas to be buying, but you have to give the benefit of the doubt to the leading sectors that have led off the April 7th low: tech, communications, industrials, and financials. Those are areas of the market to own. I'm not interested in owning lower volatility stuff, and that's actually going to be the last thing I leave with you guys is let's just type in SPHB against SPLV. This is your higher beta versus lower volatility stocks. And today we're going out at all-time highs. Right? So we're taking the absolute performance of high beta stocks and we're dividing it by the absolute performance of lower volatility stocks. We're at all-time highs. This is telling you that regardless of the fears of tariffs and inflation and geopolitical bullshit and everything else, the market is buying higher beta stocks, folks. So position yourself accordingly, buy those higher beta stocks. That's what I'll be focused on the pullback. And hopefully, if everything goes well, we'll make a bunch of money in the second half of 2025. Think there's a pullback coming? Would you start trimming your August positions? I personally am not. I mean, we had the same conversation about the Julys, right? We knew that this week was supposed to be weaker than the previous week. Seasonality tells us that the week after 4th of July tends to be slightly weak. I didn't trim any of the July stuff that was up 1,000+%, like last couple contracts on a big trade. I let them continue to run this week, and that was the right decision. This week has been good for those types of trades. So no, I will not be looking to trim the August positions earlier than usual unless, unless some data comes out that pushes us in that direction. But as of right now, no. We continue to let the stuff go. Okay? All right, folks, so that's the game plan. If you have any questions and you're inside of TTI, leave a comment below the video on the market research portal. I'll get back to you as soon as I can. If you're not inside of TTI, feel free to reach out to me if you're interested in joining. Okay, enjoy the rest of your Friday, and I'll catch you in the chat room, TTI, in about 30 minutes. See ya.